one of the biggest risks is the trade tensions can escalate quite quickly in the future. That can hurt the housing market, particularly through its impact on consumer sentiment. I think the pool of first-home buyers is going to increase. It's going to have quite a material impact on the markets. It will potentially create a bit of a situation where those that get in early are probably going to benefit the most. There's always a risk that there will be changes to those tax systems, particularly on the capital gains for investors, as well as the negative gearing.
Welcome back to another episode of the Property Nerds. I'm your co-host Arjun, Paliwal, Head of Research and CEO of InvestorKit Buyers Agency. And today we're joined by a fellow nerd. Dr. Joel Bowman from the team at Domain is here to talk to us about Domain's recent research on profits and losses. What's happening across Australia, which segments have had some great resale profits, and amongst all the different challenges that COVID, interest rates increasing, borders shutting, or markets shifting in sentiment. What has that done to delinquency rates? What has that done to profits? What has that done to resale impact? We unpack some of the things here alongside the resilience across housing markets with Dr. Joel Bowman from the team at Domain. Let's get straight into it.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover hot and cold markets, latest headlines and trends.
Dr. Joel Bowman, welcome to the show, my friend.
Thank you so much. Thank you for having me.
Well, mate, we are massive fans of the data at Domain. And the cool thing about today is we're just down the road from each other in the studio as well. So not too far of a trek for you.
Yes, it's good. Yeah, glad it worked out.
Well, mate, we wanted to get into some of the data around, resale profits, which is a key focus because I think it goes against all the doom and gloom statements many people have when we see how well Aussies are doing against property or looking at property in their portfolios and their resale values. But Perth and Adelaide are big standouts when it comes to the resale profits there. What do you feel has been a key part of the drivers for these two markets in comparison to the slower ones in Sydney and Melbourne when it looks at their resale profit values?
Yeah, so for Perth and Adelaide, what we've seen is a dramatic increase in house prices over the last few years. So we've seen house prices in both Adelaide and Perth up around 80 to 90%, so quite remarkable. And that's in contrast to Sydney, where prices are up around the 50% mark. So what we've seen is that given the strong uplift in prices, that's starting to filter through into really strong profits. And when people do sell, they're getting a pretty hefty profit when they do. In terms of the profits, kind of the prices, what's actually driving that? So in Perth, I think a big factor there is the strong economic kind of fundamentals. So incomes are rising, the unemployment rate's really low, and you've had a dramatic surge in population where it's just been really difficult for supply to keep up. And you can kind of see that with vacancy rates less than 0.5%, which is really low given that we typically like to see vacancy rates around the 2.5% range before we kind of classify it as being in balance. So that's all put dramatic, upward pressure on prices there, and that's flowing through into profits. For Adelaide, it's really been the standout market since the pandemic, and we're seeing that flow through with the as well. So for both houses and units, they're up 90% since the pandemic. I think a big factor driving kind of the Adelaide market was kind of conditions just prior to the pandemic. I think it was one of the most kind of affordable cities then. And then with the economic kind of conditions following the pandemic, with the dramatic lowering of the kind of the interest rates, conditions were ripe for the markets to kind of pick up in a big way. So affordability wasn't as much of a break on the market compared to a lot of the other kind of capital cities. Although in saying that, I think it'd be hard pressed to say Adelaide's an affordable market now. We've got the typical prices in Adelaide are very close to the likes of Melbourne now, which is quite a dramatic shift. So looking ahead, although profits have certainly surged, we're starting to see some early signs that conditions are cooling there.
Yeah, that's some really strong insights on those two markets. I think just going into those two a little bit deeper before I hand over to some of the other guys on some insights, I have been a huge fan of the Adelaide market going back many years and the results that's produced for so many of our clients. But I feel like stigmas sometimes really make people miss out on opportunities, as you've seen the numbers you quoted between Perth and Adelaide versus Sydney and Melbourne over the last 5 years. What do you feel it is that investors need to maybe consider more to avoid these broad blanket statements? For example, the sleepy city, of Adelaide, or not much going on there. And, just typical Aussie casual lingo that goes on and these labeling. But then we look back and we go, hold on a minute. You could have been almost twice as much ahead on your portfolio on an investing decision if you took back 5 years ago how markets like Adelaide had done. What do you say to those people? Because you're the barbecue's most popular person when it comes to your expertise in data. So what do you say to those people who go, have a thought that's already, thought of before they see all the numbers?
Look, I think it's just kind of natural when people are looking to invest. It's very easy to gravitate towards what's familiar. So, the street, the street around the corner, they kind of know those markets. But I think this is where these podcasts are really great. So in terms of getting the data out there and increasing awareness and of the possible investments that people can actually make. So when they are making the investments, they can consider a broader range of markets and assets so they can actually make better decisions, which will kind of set them up better. So, and I also think in terms of the stigma, I think even just showcasing the data, Adelaide has been the strongest performing market in both houses and units since the pandemic. 90% price growth, which is dramatic. So, as I said, Sydney's 50% in terms of houses, and then for the unit market, it's been an absolute standout. So, I think with those strong, increase in prices, I think it's pretty easy to, I guess, dismiss or hopefully shift some of the stigma around that market.
Absolutely.
Awesome. It's great to see some of the results that we've had, especially for a lot of the clients that, have purchased in Adelaide. But if I kind of shift it to the other side of things where results haven't been as good, I've got a couple stats on two markets. And in particular, we have Melbourne and Darwin unit markets where they've kind of struggled a little bit. Yeah. And the numbers that we have here are 73% and 53.4% of sales turning a profit. So only those percentages compared to, your other markets where everything is turning a profit. So do you see these as sort of short-term downturns, or do you think that structurally there is something that is really challenging within these markets and a lot of people are going to continue to struggle to take profits out of these markets?
Yeah, that's a really good question. So I think overall, the profitability in units is a little bit less. So across Australia, about 90% of property sales during the first half of this year for units turned a profit. So quite a decent proportion, as you highlighted. The numbers are a bit lower in Melbourne being kind of around the 70% range, and Darwin a little bit lower than that. I think in terms of why that's the case, again, it comes back to what we've seen in prices over the last kind of 5 or so years. So prices in Melbourne for units have been largely unchanged. And I think a big reflection of that is just the broader kind of Melbourne market. Even in the housing segment, prices have really kind of underperformed there. I think some of the factors driving that is some of the regulatory kind of changes, as I'm sure you've probably talked about a fair bit. Some of the changes to the tax systems hasn't been as investor friendly, and that's certainly dented the prices that we've seen there. For Darwin, it's definitely a very different market there. It tends to be a little bit more kind of volatile, given that it's a much smaller city. More of the population is transitory, so you get a lot more kind of people that go there for maybe a few years for work reasons, and then they leave. So that kind of changes the market dynamics there. But again, going back to the question, is that a structural kind of issue? I don't think it is. I think you'd be hard-pressed arguing that there's a structural oversupply of housing in Melbourne or Darwin. Both of them have vacancy rates that are still considered quite low, particularly in Darwin. It's very hard to get a rental. And so if you're thinking about it more broadly from an investment point of view, perhaps those units in Darwin hasn't delivered those really strong kind of capital gains, but it's also the market that's attracting the highest yields as well. So yields for units in Darwin are about 8%. So that's almost double that compared to what you get in like for a Sydney unit. So although you may not get those capital gains, you're perhaps getting kind of more cash flow. So you get those cash flow benefits as well, which could negate that to some extent.
Do they have like a lower supply of units in general, Darwin?
In terms of the composition, I think it's...
Just trying to think of how they can get 8% yields on the units. It's got to be a less of supply maybe.
Yeah, well, look, to be honest, the vacancy rates are really low in Darwin. So, and I think that's often kind of overlooked. So we've got really low vacancy rates in, the Perth, Adelaide and Brisbane, but Darwin still has very low vacancy rates. And you combine that with people still have pretty good incomes in Darwin. As I said, it's very transitory to some extent. A large share of people kind of go there for work. They're getting good incomes. They can pay for kind of decent amount for rents, and maybe they don't want to lock themselves in for to actually buy and get involved with stamp duty or anything like that. So.
Yeah, absolutely. I mean, on the Melbourne part, I want to touch on that real quick. I actually. It's quite sad to see what's happened in Melbourne, but there's also a positive to it on the other side. Like the sad thing is that we see countless portfolios all the time, and they're showing Melbourne unit purchases from 10 years ago, ranging between $400,000 to $550,000 in the heart of the CBD. I'm talking cafes right at your doorstep, the river walks, the gym, the CrossFit's right there, the job in 5 minutes you're walking to it. Like everything, if you thought of like a perfect life of like having everything around you in a stone's throw, is right there. Yet fast forward 10 years, we're speaking to these people who are coming to us and going, I haven't made any money on those. Can you help me to try and figure out what I should do next? It's just wild, right? But then you've got the flip side to it, which is affordability. Like there's such a big affordability thing, which is why I also, suggest challenging some of the notions of affordability. Is like, we have problems in certain scatters of markets, but Melbourne units are a clear example of where it's very affordable. And so I think it's more a statement rather than anything, just to say that I feel like people really need to throw away all this thought on what they think drives markets, because that right there could have been the perfect situation for someone to look at and go, well, it's got everything, but it hasn't done that. And then on the opposite side, when people zone in on housing affordability, they need to look at it really micro, not macro, because I think the problem is we keep having macro conversations on housing affordability when I'm still seeing some of the clients resell these properties or sell these properties they had from 10 years ago where they bought on their own, and they're selling that, and it's like, I'm selling it for exactly what I bought it for, which means someone else is potentially buying them with 5% deposits down on a 400 and something K in the heart of the CBD. So it's just wild to just think of that. I just thought I'd throw that out there.
Yeah.
Let's be honest, spreadsheet fatigue is... That's why we introduced ARI, the Advanced Rental Income Calculator by InvestorKit. It's Australia's most sophisticated, user-friendly tool for analysing potential property returns, and it's built to replace all those clunky spreadsheets you've been wrestling with. ARI gives you clear cash flow and growth projections over 10 to 30 years, updates in real time with AI-powered data, and evolves based on your feedback. Whether you're new to investing or scaling up your portfolio, ARI helps you crunch the numbers like a pro. Access it now. Head to investorkit.com.au, link in the show notes.
So I think we can all agree that the housing market has been pretty resilient, right? But I just wanted to ask, do you see anything potentially in the next 12 to 24 months that could be a major or minor disruptor to that, maybe policy related? Like I've heard of some of the changes that they put in New Zealand, like something major like that. Do you see anything in the pipeline for Australia?
Look, I think for me, one of the biggest risks is the broader macroeconomic kind of uncertainty, and particularly in relation to international trade policies. So we've certainly seen this year a bit of a roller coaster in terms of trade protectionism. At the beginning of the year, the United States announced some pretty harsh kind of tariff measures on the rest of the world. Since then, it's kind of, the United States has stepped back from those, and markets have essentially have priced in that those trade risks have largely abated. So we've got equity markets near record highs, etc. But I think it's pretty difficult to work out with the Trump administration what they're going to do next week, let alone in 6 months' time. So I think there's always a risk that the trade trade tensions can escalate quite quickly in the future. That can hurt the housing market, particularly through its impact on consumer sentiment. So our consumer sentiment here has been, tracking higher over the last kind of, it's currently on a 2.5-year high, but there's always a risk that an escalation in those trade measures offshore could dent consumer confidence here, make people less confident to go out and transact, and that could weigh on economic activity. So I think that's the big one. Good point about the regulations. I think there's been growing risk that there will be some changes on the regulatory and tax front.
I knew he was going to say that. As he was talking about the first point, I was like, oh, he's not going to bring up labour and negative gearing. And then he started talking, I was like, oh, here we go. Here it comes.
It's over the last month, we've had the Economic Roundtable in Canberra. So that's been a collection where you've had the top policymakers, economists, business, union kind of officials as well, discuss ways in which we can lift kind of productivity. And a big component to that is tax. And so how do you actually go about changing that? So, and I think especially in terms of the growing awareness about the intergenerational kind of equity as well, growing pressure in terms of addressing the decline in home ownership. How do you go about kind of doing that? And so I think there's always a risk that there will be changes to those tax systems, particularly on the capital gains for investors, as well as the negative gearing setup. So I'm not expecting that's going to be a big change in the near term, but I think the risks of a change to those settings are probably increasing. And if there are changes, I suspect that the way in which they are implemented will have a big impact. So for example, maybe the near-term market impact may be mitigated if some of these are grandfathered, which I would expect a lot of them kind of would be. And then the other one is just in terms of the credit policies as well. So the housing market, I think we're gearing up for a very busy spring selling season. We've got people's incomes are rising. You've got a structural undersupply of housing, lower interest rates. Domain's just recently put out some research which has highlighted that prices typically increase by 2% extra during the spring selling season compared to other times of the year. And then combined with that, the government's just pulled forward the announcement about the lender's mortgage insurance, or the home guarantee scheme, which removes the need for a lot of first-home buyers to purchase lender's mortgage insurance. So I think all of that will gear up. We may see activity increase in a pretty material way. If that's the case, there's always a risk that APRA may step in and tweak some of the lending rules down the track in order to potentially offset or take some of the heat out of the market. But again, I think that's probably like a minor risk. It may affect some certain market segments more than others.
Now, the anticipation on the October 1st, changes coming up for first home buyers, that is huge. We're talking no income limits, no caps, large price points across many parts of the country. And we're talking first home buyers everywhere, which, by the way, even pre these caps, home buying lending through ABS indicators from owner occupiers has been pretty healthy. And the first home buyer segment also has been pretty healthy. And so when you look at that, this is another massive firepower in terms of first home buyers. But does it feel like first in sort of gets all of this and then prices really do follow and flow on? What's the analysis or thought been from Domain side when it comes to incentives, first home buyers, things like that?
Look, it's a very good question. So, look, our thought is that it's going to have quite a material impact on the market. So, lenders' mortgage insurance can be quite costly for first-home buyers. I think one of the largest barriers to getting first-home buyers through the door and onto the property ladder is that deposit barrier. And this has a massive impact in terms of reducing the need to save as large of a deposit. So we think that will lead to a much larger segment of the first-home buyers kind of coming to the market all at the same time. So I think the pool of first-home buyers is going to increase because they don't have to save as much. And then the capacity to pay will also kind of increase. And as you mentioned, some of those price cap thresholds are quite I think, are quite generous. So people can buy a home worth $1.5 million in Sydney under this scheme. So I think that will lead to a large increase in demand. And this is also in an environment where we've got a structural undersupply of housing as well. So I think it will potentially create a bit of a situation where perhaps those that kind of get in early are probably going to benefit the most as those increases in prices, which are likely to result from some of these measures, will potentially negate some of the near-term benefits.
We've seen the top end of the market represent really strongly in the profit side, but also on the losses side, we've seen many top end of the markets as well represent itself on both ends. So when it comes to premium or prestige property, is it more prone to shocks and gains in environments of macroeconomic changes based on some of the reporting or the profit and loss things that you've seen?
Yeah, that's a good question. So I think in terms of why they kind of dominate the top of the list is just because of the price points. So if you're thinking about the nominal change, so if you've got the same percentage kind of change, it's just going to have a bigger impact in dollar terms at the upper end of the segment compared to at the lower end of the segment. In terms of whether they're more susceptible to those ups and downs, I think in terms of the looking at the analysis about the duration and the size of the peaks and troughs, I think there isn't a material difference between how the cycles behave between the upper and the lower segments. So for the Sydney market, the upper end is the most interest rate sensitive in the near term, and this time around it looks like there's no exception to that. So the upper end of the market has been quite responsive to those lower interest rates, and that indicates that the lower end or the middle to the lower end segments are likely to follow in the near term as well.
Absolutely. And I think the upper end of the market, and correct me if I'm wrong, this is just a hypothesis or a bit of an anecdotal thought. When that market moves, sentiment must play a huge part, because I think capability isn't as difficult for that end, because if you're at the upper end of the market, you're at the upper end of earners, you're at the upper end of cash savings, you're at the upper end of desire, the upper end of dream homes, like all these thoughts that come into the mix. So my thinking is like they're much more sentiment focused, where if I don't feel good about it, transaction volumes just come off. But if they feel good about it, well, whether interest rates are quite high, they might still have the money and the ability to do so, which is why over so long we continue to see some smasher sales in some areas, even in different macro environments. And it's just interesting to see. Do you think sentiment plays a key role in some of the upper end of markets more so in comparison to lower end?
I think just in terms of the timing of the markets, I think that certainly has an impact. I suspect you're right that at the upper end of the market, I think people have perhaps more discretion on terms of when they go ahead and transact. So compared to at the bottom end of the market, where people may need to transact out of necessity because of a job change or financial pressure, etc. So I think you certainly do see that transaction volumes more sensitive to those conditions, and perhaps the upper end is kind of more kind of attuned to that as well. Following the economic data, they know when lower interest rates are coming through and the impact on borrowing capacity, opening up other kind of investment opportunities as well. So you've also got the fact that they may be more attuned to the changes in kind of conditions and are kind of first out of the gates to be able to kind of adjust to those.
Absolutely. Well, it'll be interesting to see how the bottom end responds this time, considering the first home buyer stuff kicking in from October 1st. So really be interesting to see that.
Joel, we talked earlier about the different amounts of profits that could be taken within the unit markets and how that was sitting a little bit lower compared to houses. And the numbers that we've pulled is that less than 4% of houses, when they've sold, haven't turned a profit. So they're the ones that have made a loss, which is a very small percentage contrasted to the unit side. A lot of the conversations that have been had years and years ago when the interest rates were starting to creep up and were getting higher was that there'd be a lot of distressed sales and people would be struggling with the repayments and they would have to sell at a loss. What do you think has sort of been the counterweight against that thought? Because as we've seen from the data, most people are making a lot of a profit when it comes to the houses that they're holding, even with these interest rates being quite high.
Yeah, you are right. There appears to be very few kind of distressed sales. The vast majority do make a profit. I think one of the big factors underpinning that has just been the strength of the labour market. And that just means that over the last kind of 5 years, by and large, a lot of people have been able to keep their jobs, or if they've lost their jobs, have been able to find another job quite easily. And if you're thinking about the distressed sales, what typically triggers that is normally a sudden loss of income. And we just haven't seen that play out by and large. And I also just think in terms of the amount of capital that people are sitting on as well. So given those lower interest rates, they've that's fueled a big increase in prices. And so it's just meant that there's very few people that have recently bought that are in positions where they're in negative equity. So so all in all, the strength of the labour market and just the strength that we've seen in house prices just overall just means that there's very few people sitting in positions where they're forced to sell. And if they are, they're in a position where they've got negative equity.
Well, just over $2 trillion in mortgages against $11 trillion in value. I can see where big stability sits there, and what you just said adds to that when it comes to rising prices, when it comes to negative equity being quite low. I just feel that's one of the things that your reports there really bust myths of, like myth bust, which is that just because interest rates go up doesn't mean profits erode and people are all over the place selling. And I think the last 5 years has been massive learning across borders shut, pandemics, job market unemployment spikes, and then at the same time interest rates rising. 3 major things. Like, I don't want to put them in comparison to wars or things like that, but if you throw into there tariff wars, what's it going to take for something like to really hurt the market? Because I feel more and more confident about Australian market and resilience in both jobs, economy, property, assets, when I see the last 5 years have really made, I won't say no dent, but no sustainable long-term negative dent, because people do continue to sell at profits. What do you think is the things that really shake us up, that I'm not saying scare us with, but I'm more saying to go, hey, we're going to be okay unless things like this happen?
Yeah, you are right. Look, I think by and large, the Australian market is very resilient. We've got really good, strong fundamental kind of institutions. We've got low levels of government debt relatively to other countries, so we're well positioned to respond to negative shocks. We're thinking about things that can really shift the market. So these very rare kind of black swan events. I think it comes back to those those international kind of events where you do get a sudden spike in trade protectionism, and then all of a sudden our supply chains become very disrupted and the Australian economy needs to kind of adjust in a pretty big way. But they're hard to predict. And to date, I think the fact that the Australian economy has just shown that we're quite flexible by and large and being able to adjust to a lot of these shocks. But there's always a risk that the next time round that there's a spike in trade protectionism, that it could be more severe and it could be more protracted, and that could certainly hit people's kind of confidence. And I think that's the main channel which it impacts the housing market, is that uncertainty. So we saw the Australian shares decline 15% initially following the Trump tariff announcements earlier this year. So there's always a risk that could be a larger announcement down the track that has even a larger impact on people's, on the equity markets, people's superannuation balances, and that triggers that pessimism here, which can hinder activity and outcomes in the housing market.
Well, Dr. Joel Bowman, thank you for your time today and the reports here that you've shared with us and the Property Nerds audience. Thank you to the team at Domain as well for just continually sharing insights like that, helping us understand more about where Australian property markets are at. Really appreciate it. Thanks for coming in.
Thank you so much for having me.
Thank you so much for tuning into this podcast. To hear more like this and to help us spread the word, don't forget to leave us a rating and follow along for our next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.